HSBC has reported a 65% plunge in profits for the first half of the year as the pandemic bites. The lender has also warned of rising bad debt charges and a falling core capital ratio. Pre-tax profit for the first half came in at $4.32 billion. That's lower than the $5.67 billion average of analysts' estimates. Following the earnings report, its stock closed about 4.3% lower in Hong Kong. That made it the biggest drag on the benchmark Hang Seng Index today. It is slumping in trade on the London bourse as well, trading down by 4.7% this hour. Roland Lim reports.
CEO Noel Quinn described the first 6 months of the year as some of the most challenging in living memory. He says in a statement that the first half performance was impacted not just by the COVID-19 pandemic, but falling interest rates and increased geopolitical risks, as well as heightened levels of market volatility. But banks, not just HSBC, have been hammered by the market volatility and economic slowdown caused by the pandemic. But HSBC has a further headache: geopolitical tensions. Its status as a major conduit between China and the West. CEO Quinn says he acknowledged that HSBC is operating in a difficult geopolitical environment and that current tensions between China and the US inevitably will create challenging situations for a bank like HSBC with its footprint. Remember, last week, HSBC was caught in the middle of a media storm over accusations that HSBC colluded with the US government to take down Huawei, and this has led to speculation that it could lose its business on the mainland. 2 consecutive quarters of massive loan loss provisions, as well as a deteriorating economic outlook, are serious challenges for the bank. So there is a mandate to actually speed up a revamp of the bank. Remember, CEO Quinn has already announced this. He said that the bank will be accelerating implementation of a planned restructuring that was announced in February, and this includes merging the retail as well as the health management units, cutting its European equity businesses out, as well as reducing branch networks in the US.